Okay, part 3 of chapter 1. We're going to get into some of the transactions and how we actually record them. We're going to get to show you a lot of examples that will be helpful as you go through and try to apply them. They'll help us build into what we see in chapter 2. So first we're going to start out by looking at what we call the accounting equation. So like I said, there are rules for everything in accounting, and it does matter the process that we do things. So the accounting equation, the basic equation is listed here at the top, and it says assets equals liabilities plus equity. So let's get into what are they? Well, our assets are going to be all the good stuff that a business has. So anything that we own that has value. Some examples could be cash. It could be accounts receivable where someone owes us money. We could be looking at inventory that we're going to sell. We might have a land or a building. We might have equipment to operate our company. Those are all examples of assets or things that we own. Now again, I did use the word accounts receivable. So receivable refers to the term that means that someone owes us money. We're going to receive money sometime in the future. So that typically happens when we sell to someone on credit. So just keep that in mind as we go through the next one. So the next category is liabilities. So this is a debt. So we owe someone money. We have a liability to someone. So it's an amount that the business owes to someone else. So it's something that we're going to pay to someone later. So you'll see that most liabilities have the term payable in the title. And that means that, we're going to pay someone later for the debts that we've created for our company. So some examples might be a wages payable, where we have to pay wages to our employees. We might use something called accounts payable, where we're going to pay to our suppliers. We might have a note payable that we're going to pay to our bank. We might have a mortgage payable to pay for our mortgage on our building. And those are all liabilities or things that we owe to someone else. The next category is equity, and you see that it actually has several parts if you look at the expanded accounting equation that's down below. So there are 4 parts to this. The first one is called owner capital. The second one is owner withdrawals. Then we have revenue and expenses. So when we expand those, they are all part of equity. So they're all part of what the business owes to the owner. So if we sold the business and we paid all that we owe for the liabilities, the owner will be entitled to the difference, which is the equity. The equity is increased with the 2 that you see in green, capital and revenues. It is decreased with the 2 you see in red, if the owner withdraws money or if we have to pay expenses. So equity has 4 parts: capital, withdrawals, revenue, and expenses. It increases with capital and revenue, and it decreases with withdrawals and expenses. So when we're talking about them, capital is when an owner invests cash or other assets into the company. So when the business is started, they either have to be putting in cash or they might be putting in equipment or a building, but they have to have something that they're contributing to the company to be able to get ownership in the company. So that's what we call owner's capital. If later the owner wants to withdraw money from the business, we use a separate account called owner's withdrawals, and that's going to decrease the equity in the company. We talked a little bit before about revenues. When we sell a product or we provide a service, we're going to earn money. That goes into revenue. And then the other thing we have is expenses. So expenses are what we have to pay to operate our company. You'll notice here on the slide that it also says revenue minus expenses gives us net income. And that's showing us that if we subtract the 2, what we earned from our customers from either providing a service or selling a product is our revenue. If we subtract out the expenses we needed to operate our business, if revenues are higher than expenses, we have net income. If our expenses exceed our revenues, then we're going to have a net loss. All right, so let's get into looking at some of these accounting transaction examples. And there are several of them, so we may get through it in this video. We may have to continue into another video to complete them. But let's look at some of the transactions that they give us as examples. So our first one, it says that Chaz Taylor invests $30,000 cash to start a business named Fast Forward. So the owner is Chaz Taylor. They're forming a consulting business, and Taylor is personally investing $30,000 cash in the new company. They're going to deposit the cash in the bank account opened under the name of the company, Fast Forward. So first we have to identify the assets, liability, or equity accounts that are involved in this transaction. So we can see that the cash account will increase by $30,000, and in exchange, Chaz Taylor capital will increase because the owner, Chaz Taylor, is getting equity or capital in the company, so it's also going to increase by $30,000. So now let's see how the different other transactions of the books in the company will appear after we record this transaction. So let's look at the flow of assets and liabilities. Remember, we said that the accounting equation is assets equals liabilities plus equity. That accounting equation has to balance at all times. So for it to balance, we are going to illustrate it here, and we're going to do this with every transaction. So we can see with the increase in the asset account, cash was $30,000. And the increase in equity, $30,000 for C. Taylor Capital. So our basic accounting equation is in balance. Assets has a total balance of $30,000, liabilities has a balance of 0, and equity has a total balance of $30,000. So our accounts are our equation is in balance. Let's look at another transaction. So this one, it says the company purchased supplies by paying $2,500 cash. So one thing I want to point out is that, as we operate a company, we are going to have to buy supplies. Those supplies will be used. So right now, it's just something that we're buying, and let's assume it's office supplies. We're going to buy those supplies. We're going to put it in our office supplies closet. Later in Chapter 3, we'll learn what happens with the supplies that we've used. But for right now, we're just buying the supplies. So if we're buying supplies, where it says that we're paying $2,500 cash, so our cash is going to be decreasing. So one asset is decreasing, another asset is increasing, but our supplies are increasing. So we're getting supplies. How are we getting it? We're paying cash. So one asset is going up, one asset is going down. So how does that look for our accounting equation? Well, we can see that we had assets increase under supplies, assets decrease under cash. So the net asset amount was 0, right? So there's no difference in our accounting equation totals. We have $30,000 on the left, $30,000 on the right, so we're still in balance. All right, our next transaction. It says that we purchased equipment for $26,000 cash. So it's similar to our last one we bought supplies. This time we're buying equipment, so we're buying another asset. We're paying $26,000 in cash. So our cash is going to decrease by $26,000, and we have a new account called equipment that is going to increase by $26,000. Once again, we're exchanging one asset for another. We're getting equipment in exchange for cash. So what would our books look like after recording this transaction? Again, it's going to be the same. The accounting equation still remains in balance. We have $30,000 on the left side, $30,000 on the right side, which is what we want to see. All right, let's look at transaction 4. So this one says we purchased supplies of $7,100, but it's on credit this time. So we're not paying out cash. So we're agreeing to pay off the account sometime in the future. So here we're getting supplies again. So our asset of supplies is going to be increasing. But we're creating a liability because we're not paying out cash. We're saying we're going to pay it on credit, which means we're going to pay it sometime in the future. So we're creating that payable that we're going to pay based on terms that we agree to. So we're going to set up a liability for $7,100. So our assets are increasing $7,100 because we're getting supplies for that value. And our liability on the right side of the equation is increasing $7,100. So that's what we can see here, that our accounting equation is still in balance. Supplies increased on the left side of the equation, liabilities increased on the right side of the equation, so it's still in balance. All right. The next few transactions are going to be looking at revenues, expenses, and withdrawals. We haven't seen those yet, so let's look at number 5. So number 5 says that we are providing consulting services to a customer, and we're getting paid or receiving $4,200 cash right away. So we provide service, they're paying us right then. So they're paying us in full at that point in time. So we have cash that's going up because we're getting cash right then. And the other side that's going up is our revenue, which is an equity account, but remember we have 4 categories of equity, so we're breaking that down. Our revenue is increasing because we earn money, and we're getting paid for that revenue with cash. All right, let's look at another one. I'm sorry, this part shows how it balances. So again, we're still in balance. Now let's look at another one. So this one is transaction 6 and 7, and it actually says we paid rent of $1,000 and we're paying salaries of $700 to employees. So we have 2 different expenses we're paying here. But with both of them, we're paying it in cash. So our cash is going to go down by the total. So our cash is decreasing $1,000 for rent and $700 for salary. So our cash is going down $1,700 total. We have 2 different expenses though, and we have to make sure that we classify them under those 2 different categories. So we're going to record rent expense. So the amount of the expense went up and the amount of salaries expense went up. So remember, the expense account itself is increasing. But because expenses deduct from equity, our overall equity is going to be reduced. And I'll show you how that works. So let's look at the process here. So we had a balance of cash of $5,700. We paid out $1,000 and then $700. So that brought our total here to $4,000 cash that we have left. Over here, expenses were incurred, but expenses are subtracted from revenue because they decrease that equity. So we're going to put those in parentheses on that side to show that they decrease the equity. All right, let's look at number 8. So number 8, it says that we provided consulting services of $1,600 and rents facilities for $300 to a customer for credit. So this one, the asset account, accounts receivable, is going to be used because it says for credit. So they're not paying us right now, they're going to pay us later. So they're paying us for consulting services of $1,600 and rent facilities of $300. So we're setting up a receivable because they're going to pay us sometime in the future. So it's cash that's coming to us in the future, but because we don't have it yet, we record it as something we're going to receive in the future using accounts receivable. We had 2 different types of revenue. Just like when we have different types of expenses, we want to record our revenue separately because we want to make sure that we're accounting for everything in detail. So we had consulting revenue that was $1,600, and we had rental facilities revenue or rental revenue of $300, and we're going to record them separately. So that's what we see here. We actually see that we had total accounts receivable of $1,900, but we broke down that revenue into 2 different types of accounts. Our accounting equation is still in balance, which is what we want to see. All right, we have 2 more equations or 3 more transactions. We'll see if we can get through it in the next minute. We'll see. All right, so in this one it says the client from transaction 8 paid $1,900 for consulting services. So remember we had that accounts receivable that we were owed? Now they're paying us. So we're going to be getting cash, so cash is going to go up, and the amount that they owe us, that receivable, is going to go down. They owe us $1,900 less now, so we're going to see that. And we can see that accounts receivable is now $0. Our cash went up, our accounts receivable went down. Our accounting equation is still in balance. All right, for our next one, they're paying $900. We are paying $900 as partial payment for the supplies we purchased in transaction 4. So we're paying on this accounts payable $900. So cash is going down and the amount we owe is also going down. We'll continue in the next video.